Welcome to This Explainer. Today we're diving into Archrock, a stock that perfectly illustrates this wild tension between unstoppable market momentum and, well, cold hard fundamental reality. If you follow energy infrastructure, you definitely know the name. But today we're looking way past the ticker symbol. We're going to dissect the raw numbers and uncover what is essentially a classic investing paradox. Okay, let's just jump right in and look at this massive number. 319.93%. That is Archrock's insane 3-year total return. I mean, this kind of explosive wealth generation is what investors spend their entire careers chasing, and it fundamentally frames exactly how the market is viewing this company right now. So, Section 1, Exploding Momentum and Returns. Let's see how we actually got here. What's really wild about this is the relentless exponential growth across every major recent time horizon. We aren't just looking at one lucky year here. We're tracking a 69% return over the trailing 12 months, that 319% over 3 years, and a staggering 430% over 5 years. This stock has practically defied gravity. And this brilliantly illustrates the current bullish sentiment. The stock is practically hovering at its absolute peak. At $39.02, it's sitting just pennies, less than 1%, below its 52-week high of $39.40. The market is basically pricing Archrock for absolute perfection, showing immense confidence in where it's headed. When we look at the compound annual growth rates, the story really solidifies. This hasn't been a short-lived spike, you know? Compounding money at roughly 39% a year for half a decade is an absolutely elite level of market outperformance. Moving right along to Section 2, unpacking the profitability surge. Stock prices rarely climb this high without an engine driving them, right? By comparing the current net profit margin of 17.48% against its 3-year historical average of 12.59%, we see a company that has become significantly more efficient. That's a massive 70% improvement over its baseline. They aren't just making more money, they're keeping a much larger slice of every single dollar that comes in the door. And here is the fuel for that engine. Near 100% year-over-year earnings per share growth across multiple timeframes. Just look at that 3-year EPS CAGR of almost 116%. Operational profitability is literally exploding, which completely explains why the market has enthusiastically bid up the share price. The earnings engine is running red hot. All of this translates directly to the shareholders, with return on equity sitting at 21.39%, representing a massive 68% jump over the 3-year average. Management is clearly maximizing the value of shareholder equity. Honestly, if you're an investor looking purely at earnings momentum and margin expansion, Archrock looks like a textbook winner. But hold on, because here is Section 3, the hidden dividend dilemma. This is where we start to see some cracks in the foundation. On the surface, the dividend profile looks perfectly healthy. It offers a solid 2.26% yield and a great track record of 3 consecutive yearly increases. Plus, the standard earnings payout ratio is a very comfortable 45.60%. By all traditional metrics, this dividend looks rock solid and totally safe. Well, actually, scratch that. Look at this figure, 121.31%. That is their free cash flow payout ratio. This reveals that Archrock is paying out significantly more cash in dividends than they actually generate in free cash flow. Remember, earnings are an accounting metric, but dividends are paid in cold, hard cash. And right now, the business simply isn't generating enough to cover the check. Which forces us to ask a really critical question. Is this dividend actually sustainable? When we pair that 121% payout ratio with a 5-year free cash flow CAGR that is actually negative, down 9.30%, we have to question the long-term viability of these cash rewards. You simply cannot pay out more cash than you bring in forever without eventually stressing the balance sheet. And that cash flow dilemma leads us directly to Section 4, a brutal valuation reality. This is where the math hits you like a brick wall. Despite the operational growth and soaring earnings we just talked about, discounted free cash flow models calculate a fair intrinsic value of just $7.31 per share. Yet the stock is trading at $39.02. The gap between what the market is paying and what the cash flows dictate the company's actually worth is absolutely massive. To really grasp how severe this gap is, we need to understand the margin of safety. Value investors rely heavily on a margin of safety to protect themselves from downside risk. The idea is simple. You want to buy $1 for 60 cents.
You never, ever want to pay $3 for a 60-cent asset.
Which makes this data point deeply alarming. Based on free cash flow fair value, Archrock has a margin of safety of negative 433.63%. There is literally zero cushion here. The market is pricing in decades of flawless, uninterrupted growth, leaving absolutely no room for error, economic downturns, or execution missteps. This creates a wild conflict in the valuation metrics. The PEG ratio looks artificially cheap at 0.28, but that's because it's based on that soaring accounting earnings growth. The price-to-free cash flow ratio, though, it sits at 56.78, cutting through the noise and highlighting how wildly expensive the stock is relative to the actual cash it creates. It's an optical illusion. It looks cheap on earnings growth, but it's vastly overpriced on actual cash generation.
Which brings us to our final crossroads, Section 5, Momentum versus Fundamental Value.
It's like a giant tug of war. On one side, we have undeniably explosive market returns, soaring profit margins, and skyrocketing earnings. But sitting directly across the table, terrifying cash flow deficits, stretched intrinsic valuations, and an unsustainable free cash flow dividend payout. So as we wrap up this explainer, we leave you with the ultimate valuation paradox. Archrock presents the classic investor dilemma. Do you ride the wave of undeniable operational momentum, or do you heed the stark warning of discounted cash flow models and negative safety margins? When market momentum completely defies fundamental fair value, which data points will you trust? Thank you so much for joining me to unpack these numbers. I'll leave you to ponder which side of the paradox you'd bet on.